Welcome to the video tutorial Dynamic Perspective Flow Figures. This tutorial has been prepared to provide you with background information on selected accounting figures used in the field of business management. After a short review of the terms flow and stock figures, the following topics are addressed: profit, accrual-based accounting, cash flow, cash-based accounting, dividend distribution, profit versus cash flow. The video tutorial will be concluded by a simple example and an imprint. Which two basic types of measures are used when modeling economic activities? The two basic types of measures are stock figures and flow figures. In this unit, two key concepts of flow figures are examined in more detail. The first flow figure to be examined is profit. What is profit? For a given period, profit is equal to revenues minus costs. Revenues are equal to sales revenues plus other income. What is the difference between sales revenues and other income? Let us look at an example. In addition to steel as its main product, a steelworks produces the byproduct slag. Normally, there would be costs associated with the disposal of the slag. However, unexpectedly, a producer of building materials is found who wants to buy up the slag and process it further. Here, the sale of steel leads to sales revenues, and the sale of the byproduct slag leads to other income. Generally speaking, one can say that the term other income refers to income that is not linked to the main operations of an economic entity. Costs are equal to COGS or COS plus other costs. COGS or COS are abbreviations that stand for costs of goods sold or cost of services sold. COGS or COS include all direct costs while producing goods and/or services that are sold or provided to customers. Other costs are costs that cannot be directly linked to the production of goods or the provision of services. Examples are overhead costs, not related to production, general marketing and sales costs, research and development costs, etc. Profits can be used in order to quantify the amount of dividends that can be paid to owners, for example shareholders. Finally, it should be noted that losses are negative profits. The flow figure profit is based on the concept of accrual-based accounting. What is the accruals concept? When the terms accounting or bookkeeping are used, they refer to accrual accounting. With the help of three aspects, the concept can be outlined. First, the realization principle. Profits from current operations are only allowed to be shown in the balance sheet if they have actually been realized. Second, periodic profit determination. Revenues and costs must be booked at the time they arise. Third, payment independence. Revenues and costs are considered regardless of whether payments have been made. Profit and losses are reported in a separate statement, which is referred to as either profit and loss statement or income statement. The second flow figure to be examined is cash flow. What is cash flow? For a given period, cash flow, or rather net cash flow, is equal to cash inflow minus cash outflow. Cash inflow simply refers to all payments received. Cash outflow simply refers to all payments made. Net cash flow increases the net cash position, which can be used to make payments to owners and/or third parties. The flow figure net cash flow is based on the concept of cash-based accounting. What is the cash concept? When the terms treasury or finance are used, they refer to cash-based accounting. With the help of three aspects, the concept can be outlined. First, the irrelevance of the realization principle. Cash flows are to be reported regardless of the realization of the underlying business transaction. What does this mean? If an entity receives or makes a payment that is not directly related in time or matter to a sales transaction, that payment must still be reported as cash inflow or cash outflow. This will be further exemplified in another unit. Second, periodic cash flow determination. Cash inflows and cash outflows must be recorded at the time they are made. Third, payment dependence. Payments must have actually been made. Net cash flows are reported in a separate statement, which is referred to as a cash flow statement. Why are profits and cash flow prerequisites for dividend distributions? First, there are prerequisites related to the flow figure profit. Profit was generated in the period for which a profit distribution is to be made, and/or profits from previous periods were carried forward to the period for which a profit distribution is to be made. If a dividend distribution were made without a profit for the period or profit carried forward, this would lead to a repayment of the subscribed capital. In other words, the equity base of the enterprise would be eroded. Therefore, in most jurisdictions, the distribution of profits without the existence of a profit position is prohibited or punishable by law. Secondly, for dividend distributions, there is a requirement regarding the net cash flow figure. A cash position or an undrawn line of credit exists in order to be able to make the payment. Profit and cash flow have been introduced in principle. But how are profit and cash flow related to each other? Due to the different perspectives of accrual-based accounting and cash-based accounting, this may lead to different combinations. Profit and cash flow may be identical. Profit and cash flow may not be identical. The same applies to the underlying variables. Revenues and cash inflows may be identical. Revenues and cash inflows may not be identical. Costs and cash outflows may be identical. Costs and cash outflows may not be identical. Why this is the case will be explained on the following slide. However, before the example is shown, two key takeaways resulting from the presented combinations must be pointed out. You can be highly profitable but still be illiquid. You can be highly liquid but still be unprofitable. Why are profit and cash flow not always identical? The relevance or irrelevance of the realization principle has already been pointed out earlier. This can be explained by using a simple example. A company sells goods on account in year 1. It is agreed that the customer will not pay his invoice until year 2. In the world of accrual-based accounting, this business transaction is considered a realized success, which is directly reflected in the profit and loss statement and the balance sheet of year 1 as follows. A sales revenue is posted in the P&L. Since the customer does not pay until the following period, a receivable is entered in the balance sheet. In the world of cash-based accounting, the realization of this business transaction is considered to be irrelevant. The transaction is not reflected in the cash flow statement. In the following year 2, the customer pays his bill. In the world of accrual-based accounting, this business transaction is not considered to be a realized success of year 2. Therefore, it will not be reflected in the profit and loss statement. However, the income payment increases the cash position on the balance sheet and correspondingly decreases the receivables position on the balance sheet of year 2. This does not change the balance sheet sum, because the changes cancel each other out. Quite different in the world of cash-based accounting, the realization of this business transaction is considered to be irrelevant. The transaction is reflected as a cash inflow in the cash flow statement.